Hello everyone and welcome to the Tax Gate. Capital gain tax. Interesting tax topic to talk about. So, what does it mean? And how it is calculated? Also, how it would be triggered? And what are the types of assets that would trigger capital gains? That's what we are going to discuss within this video. Hit the subscribe button and let's get started. Well, tax on capital gain is the tax that should apply on the gains derived from the sale or the disposal of capital asset, and here the term capital asset would mean any kind of property or investment we own, either movable or immovable. So in other words, it is the tax that should apply on the difference between the acquisition value of an asset and the selling price upon selling or disposing this asset in case we have profits. And here we should highlight that it's the profits only that should subject to tax and not the revenue that you receive against the sale or the disposal of that asset. Good. So now what are the types of transactions or activities that would trigger capital gains? And here is the answer. Capital gains would be triggered as follows. The direct sale or transfer of asset. And here once again capital gains would be difference between acquisition value and the selling price or the fair market value upon selling that asset. Exchange of assets or granted assets. Also upon merge and acquisition and demerger as well. And here capital gains would be triggered based on the reevaluation of the assets in place, and it would be calculated based on the difference between acquisition value and the estimated fair market value of that asset. Well, so we have just discussed the definition of capital gain tax and the types of transactions or activities that would trigger capital gains, and now let's move to the types of assets or properties that would trigger capital gains. For the types of assets or properties that would trigger capital gains, it would be qualified as follows. Let's first start with capital gains from ships and aircraft which operate in international traffic. And here from tax point of view, ships and aircraft wouldn't be considered as immovable property, and any related capital gains would normally subject to the tax rules of the country where the place of effective management is located. Also we have capital gains from immovable properties. And here we might say any other tangible properties such as buildings, lands, vehicles, equipment, and accordingly normally it would be subject to the tax rules of the country where the property is located. And finally, capital gains from movable properties. So for movable properties, here we mean the intangible properties such as holding stock or shares in a company or having rights of management or legal rights over a company, that also would trigger capital gains as well. And here let's differentiate between the following. Capital gains derived by residents, and here local tax rules should apply. And then capital gains derived by non-residents, and here normally double tax avoidance treaty rules would apply, as the beneficiary would enjoy any relief under the treaty once the treaty application is confirmed. And with this, we came to the end of our video trying to provide a quick overview of one of the most interesting tax topics, which is tax on capital gain. Like and subscribe if you would like to see more videos, and thanks for watching TaxGate.